familiar with Telus as one of Canada's big three telecommunication companies, but have you heard of Telus International? Fasten your seatbelts, folks. This is going to be a good one. Telus International is a subsidiary of Telus Corporation. It was originally created to provide customer service outsourcing and other business process services to complement the telecommunication offerings of course, Telus. However, they have expanded their range of services, adding IT outsourcing, digital solutions, and AI-backed services. In addition to that, they also grew their customer base beyond the Telus Corporation. This made it very easy for them to be able to offer their services on, an international stage. The company did IPO on January 3rd, 2021, adding the ticker TIXT to both the TSX as well as the New York Stock Exchange. Join the conversation. Let us know in the comments if you know about Telus International before this video. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. As an investor, the first thing you should do when looking at Telus International is to forget about Telus. They are separate IPOs and should be treated as such. The successes and failures of either company are they're not correlated. Though they can both respond to a negative or positive market stimulus in the same way, or they can move in a totally different direction. The true tale of this stock is going to come within their fundamentals, and normally I would call on our good old buddy Mr. Math for this part, but by popular demand, let's call on his wife, Mrs. Math. We will jump out of the gate on this one with some surface data. They have a market cap of $2.86 billion and a pretty stable beta coming in at 0.62. Their earnings per share come in at 0.52. They have a price to earnings ratio of 21.10. Now, the average amongst their peers is actually 42.7. Some of their peers include GDI with a PE ratio of 38.1 and Boyd Group Services at 52.4. They are looking like they may be undervalued, and we definitely are going to find out about that soon enough. Their price to book ratio, that comes in at 1.10. Their peer group has an average of 6.0. Once again, that's also saying undervalued. When we look at their return on equity, it is a little low at 5.0%. From the surface data, everything seems pretty good, but we never judge a book by its cover or surface, so we will dive in a little deeper and take a look at the cash. Their revenue comes in at $2.60 billion, and they had earnings of $100 million, which seems a little bit low for the amount of revenue they're pulling in. Those earnings are projected, of course, to grow by a whopping 30.9% per year. That's not too shabby. They are also expected to grow their earnings per share by 3.1%, and that is definitely something I do like to see. This projected growth is very good for their future potential for sure. They have a free cash flow of $291 million, and their operating cash flow comes in at $384 million. Let's find out if they are undervalued like we had suspected earlier. Their current value comes in at $10.47, and using a discounted cash flow model, we do get a fair value of $26.64. So that does make them undervalued by a whopping 57.5%. Holy banana bread, that is definitely a lot of room to grow. There we have it. This is a company that is very undervalued, and that could be an indication of a potential wave to ride up, but it can also mean there are some deeper issues going on here. Let's, of course, pull back another layer and see what we have for their returns. They currently have no dividend, and that is normal for a company that is still fresh off of an IPO, and they've IPO'd back in January 31st, 2021, so that's less than 3 years ago. We, of course, do have those return on investments that we can pull from. So on the 3 year, just less than 3 years, their price, it fell from $42 to $10.40. That's a return on investment of negative 75.24%. Yikes. This is pretty rough, though not entirely out of character for a new IPO that then heads into a bear market. On the 1 year, their price fell from $34.91 to $10.40, so that is a return on investment of negative 70.21%. We do have to mention that there was some shareholder dilution in the last year, which did contribute to this number being as bad as it is. For 2023, their price fell from $26.89 down to $10.40. That's a return on investment of negative 61.32%. Overall, these are terrible results, and that may scare off a lot of investors, and I don't blame anyone for saying no based on those returns. We still have another layer to look at, and let's do that. Let's take a look at their debt situation. So their total debt comes in at $1.65 billion, and they have a total equity of $2.00 billion. So that does make their debt to equity ratio ratio 82.5%. That is not as bad as I was expecting after the returns data. As far as cash and cash equivalents, they do have 143 million there. Let's look at their short term. Their short term assets come in at 819 million and their liabilities come in at 644 million. That, once again, not super bad. Long term, their assets come in at 4.14 billion and their liabilities come in at 2.32 billion. Once again, that's not bad as well. Overall, their debt situation is not as bad as it could be. They do have a lot of debt, but it is in an amount they can handle. That debt is well covered by their operating cash flow, and the interest on that debt is covered by their EBIT, or earnings before interest and taxes. So, what is the final verdict? This is a company that I really do have a hard time getting past those returns. They have yet to really show growth in the right direction, and as an investor, that can be a deal breaker for sure. With that being said, it is not all bad. The projected growth in earnings and earnings per share shows that there is a strong potential to regain much of the ground this stock has lost. Obviously, for a passive income investor, this one should be a hard pass, as it has no passive income at all. I think also anyone looking to turn some fast profits on a short-term scale, this is as risky as trying to start a campfire in a rainstorm. It is more than likely not going to work out for you. On a longer time frame, there is hope that this stock can recover, and if it exceeds expectations, then maybe there is an opportunity here. I would still caution you to come into this with eyes wide open, as this is still a wee bit of a risky one. However, I did say they are not Telus, but this is a project that Telus Corporation is very much invested in, so that may be a wee bit of a safety net for this one. When it comes to insider trading, more employees have bought shares than have sold them, and that is a good indication that there is faith within the company. When I say risk, that is just a reflection of those returns. Outside of those numbers, the overall look of the fundamentals is not that bad. So this could very well be a company I may be willing to take a chance on. If you also decide to take a chance on this one, just be sure to do a heaping helping of due diligence before you part with any of your hard-earned cash. Your money also deserves that amount of respect for sure. Keep the learning going. Watch my video on physical assets, linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.